first of all, the end game is to thank you to start out for after a month plus of World Cup. You have refocused the country on the sports rivalry of all time, the one that really matters, Yankees-Red Sox. That's the end game of the World Cup.
What a joy last night to listen to, I think, WEEI in Boston.
Yep.
Will and the team. And nobody was pulling a jersey. Nobody was stepping on somebody's ankle.
Flopping.
They have their moments, but it was great. Continue. What's an end game element?
So the question is that in this environment where we know that AI is dominating as an investment theme, where we know we're on course for political change in the fall, where we know that earnings have been unprecedentedly strong, how does the end game develop? And a lot of the questions that we've been fielding is, does this have to end like it ended in Y2K? And our answer is decidedly it doesn't, because earnings are good. And oh, by the way, you look at this year, value is outperforming growth. The stock market is very strong and the economy is solid.
So, Julian, we're getting into the teeth here of this second quarter earnings. First quarter earnings were just extraordinary across the S&P 500. Bar's pretty high for the second quarter as well. How do you feel about earnings?
It's going to be great again.
Okay.
Wow. We know that, which is why essentially as the season has started, you've had mixed reactions to earnings reports. And that's actually been a feature of the majority of this bull market. But ultimately for us, what we think investors will likely do is refocus on the stocks and the areas that have been sort of laggards and that are going to report great earnings. And oh, by the way, that's large cap tech.
Large cap tech. So where in large cap tech? I mean, Tom and I, we talk about the software stocks all the time, like a Microsoft down 20%. You rarely see that type of performance over any meaningful period of time. How about some of these software names?
Well, software is going to be pick and choose. Okay. But broadly, when you think about the Mag 7, they have been punished already for what we're going to find out this reporting period, that free cash flow, because of the AI build out, is likely to cross below the zero line. Stocks have discounted it.
I just want everybody worldwide to know that all three of us have what I call air-conditioned throat, which is in the summer. And we're saying this room is very cool because of all the electronic equipment and that. And then you go home where Mrs. Keene has an iceberg. Right. And then you get the Uber where it's, can be hit or miss iceberg. And none of us can speak this morning. So I, in advance, apologize. I'm looking at Amazon. Paul Sweeney taught me how to do this. You can see on page 2 of the DES screen, the description screen. Yep. Tom Secunda taught me how to use the screen. Yep. The institutional ownership, Evercore nails this. Are they under-owned? Are the Mag 7, when you look at percentages of index funds and all that, are they under-owned by the long-only buy side?
They are. There's no question about it. And not only are they under-owned by the long-only buy side, they also have been reasonably active shorts from the hedge funds. And we all know that it's very frequently the case. Certainly it was the case at the beginning of April that the most vigorous rallies start with short covering, and we think we're going to see that this earnings season.
What are we going to see from the Federal Reserve? We've heard Mr. Warsh a couple of times now in public. Inflation is, quote unquote, intolerable from his perspective. So it seems like the focus is on inflation. What do you guys expect from the Fed?
So we don't think you're going to get anything next week. But the problem for Warsh is twofold. Number one, the escalation with Iran has sent oil to a level that's
now over 90 a barrel Brent crude.
Right, exactly. Yep. And then you mentioned it at the top of the hour. The 10-year yield is getting to an uncomfortable place, and it looks to us like actually the U.S. has been best behaved, but it looks like you're on the verge of another global breakout higher in long-term yields. And that's a problem for the
Across
Fed.
America this morning, Julian Emanuel joins us, Evercore ISI. We thank you for listening to what you choose to listen to us on YouTube. Building, growing each and every day, humbled by the length of listening on YouTube. What Colin of the Twins told me, people have it on their phone. They're listening to YouTube while they're driving, and they turn the phone over so they can't peek.
Very
and they
good.
just listen to my lousy voice.
Perfect.
It's
That's how we roll.
that's how we roll. Paul Sweeney with Julian Emanuel.
Julian, what screens well for you guys, whether it's a sector or a factor? What's screening well for you guys these days?
So what's fascinating, again, is we are in one of these rare environments where value stocks are outperforming growth in a tape where the index is up on the year. And that is rare. But for us, what's even more fascinating is that within that, there are a universe of stocks which we refer to as negative beta. They're mostly value, but day in and day out, they've been correlating inversely to the S&P 500. And it is, in a world where AI has become the predominant investment theme, truly portfolio diversification.
I want you to talk about what you put your name at the top, but it's Michael Chu, Barack Hurwitz, and Stephen Fandozzi doing all the work. You have a report, folks. Get it from Evercore ISI. It's the best thing on the street. Earnings Edge. And it's a big, long paragraph here. What's the tone so far? Is it a revenue edge? Is it a down the income statement edge? What's the distinction so far that you publish in that document?
Well, the distinction again is that both revenue and and earnings are just absolutely unprecedented. And again, I referred to this idea that we're going to find out that hyperscalers will probably cross the zero line in terms of free cash flow. But guess what? The rest of the S&P 500 continues to move towards record free cash flow.